Imagine you're flipping through trading apps and spot the same stock priced at $100 on one exchange, but $101 on another. What if you could buy low and sell high instantly, pocketing that dollar without any chance of losing? Sounds like free money, right? But is it really that simple? Hey, today we're diving into arbitrage trading. And I'll break it down using something as simple as dice to show how it works. If you've ever wondered about ways to trade without sweating over market crashes or wild swings, this is for you. We'll look at the basics, why it seems risk-free, and the real catches that most people miss. Stick around, because by the end, you'll see if this is a golden ticket or just a tricky illusion. So, first off, let's talk about the big issue in trading: risk. Most trades involve guessing where prices will go. You buy a stock thinking it'll rise, but if it drops, you're out cash. Or you short something hoping it falls, and bam, it shoots up instead. That's the challenge. Markets are unpredictable, like betting on a coin flip where the coin might be weighted against you. People lose sleep over this, and beginners often burn through their savings chasing hot tips. Arbitrage promises to sidestep all that mess. It's not about predicting the future. It's about spotting price gaps right now and jumping on them before they close. All right, let's get into how arbitrage actually plays out. Think of it like this: markets aren't perfect. Prices for the same thing, say a crypto like Bitcoin or a share of Apple, can differ slightly across platforms because of timing, location, or just glitches in the system. Arbitrage traders hunt these mismatches. For example, if Bitcoin is $60,000 on exchange A but $60,050 on exchange B, you buy on A and sell on B at the same time. Boom, $50 profit per coin, minus tiny fees. No waiting for the price to move, it's locked in instantly. To make this crystal clear, let's use dice as an example. Picture two casinos side by side. In Casino 1, they offer a game where you roll a standard six-sided die. If it lands on 1 through 5, you win $1. On 6, you lose $5. That sounds bad, right? The odds are against you because the expected payout is negative. But in Casino 2, it's the opposite. On 1 through 5, you lose $1, but on 6, you win $5. Still not great on its own. Now, here's the arbitrage magic. What if you play both games at once? You bet $1 in each casino. No matter what the die shows, since it's the same roll for both, your wins and losses cancel out perfectly. But wait, no. Actually, let's adjust the analogy to fit better. Let me tweak that for accuracy. Suppose Casino 1 pays you $10 if the die shows even, 2.46, but only costs $9 to play. Meanwhile, Casino 2 charges $10 to play, but pays $11 if it shows odd, 135. That's not quite right. Better yet, imagine the price of betting on a die roll differs between spots. In one market, the cost to bet on getting a 4 is undervalued compared to another. But to keep it simple, think of dice faces as assets. Say you have two shops selling dice. Shop A sells a fair die for $5, but Shop B buys the exact same die for $6 because of some supply mix-up. You buy from A, sell to B, pocket $1 each time. No risk because the deal happens now and the items are identical. That's arbitrage, exploiting price differences in the same thing across markets. Now, expanding on that dice idea, let's say we're dealing with loaded dice to show how opportunities pop up. In trading, markets can be like dice that aren't fair due to news, delays, or big orders messing with prices temporarily. Suppose you know a die is loaded to land on high numbers more often, but one exchange prices a bet on it as if it's fair, while another adjusts for the load. You arbitrage by betting against the mispriced one. In real trading, this happens with currencies too. Like, if the exchange rate for dollars to euros is off between banks in New York and London because of a lag, you convert one way and back, grabbing the difference. It's called triangular arbitrage when you loop through three currencies. But here's where it gets deeper in the exploration. Arbitrage isn't just for stocks or crypto. It shows up in sports betting, commodities, even retail like buying cheap on Amazon and flipping on eBay. With dice, imagine a game where the payout for rolling a pair in 2 dice is 35.1 in one place but 36.1 in another. You could hedge bets across them to guarantee a small win no matter the roll. In trading, high-frequency traders use super-fast computers to spot these splits in seconds. They execute thousands of trades a day, scraping tiny profits that add up. For regular folks like us, it's tougher because by the time we see it, the gap might close. Tools like bots or APIs help, but you need capital to start. Say at least a few $1,000 to make the fees worth it. Moving toward the peak of this, the key moment, is arbitrage truly risk-free? On paper, yes. If everything goes smooth, you can't lose because the prices are locked. Reality bites. What if there's a delay in your trade execution? The price gap vanishes and you're stuck with a loss. Or slippage, where the price moves against you mid-trade. With our dice example, imagine trying to buy from shop A, but by the time you get to shop B, they've adjusted the price. Poof, no profit. Plus, fees eat into gains. Transaction costs, withdrawal fees, even taxes. In crypto, network congestion can trap your funds. And competition is fierce. Big firms with algorithms snatch most opportunities, leaving scraps for others. So, while it's low risk compared to regular trading, it's not zero risk. One wrong move, like a platform glitch, and you could lose big. Wrapping this up, arbitrage is a smart way to trade by playing price differences, like mismatched dice games where you win either way. We covered the basics with examples, the challenges of risk in normal trading, how to spot and execute RB trades, and why it's not as risk-free as it sounds due to speed, fees, and surprises. It's great for patient traders with tech setups, but don't quit your day job chasing it. If this sparked your interest, hit that subscribe button for more trading breakdowns.